Afternoon, sir, class, everyone else watching. I'll be briefing problem 4 from the chapter 13 problem set. So to begin, problem 4 provides us comparative balance sheets for Y company for the past 2 years as follows: 2016 and 2017, including everything from the total current assets, long-term assets, current liabilities, stockholders' equity liability, and owner's equity. The first portion of this problem asks us to utilize the format provided in the textbook and prepare a common size comparative balance sheet for the 2 years for company Y. So what does that look like? So company Y, using the comparative balance sheets, the common size statements is explained in the textbook is that all common size statements recast all items on the statement as a percentage of a selected item on the statement. This excludes size as a relevant variable in the analysis, and it's a pretty convenient way to compare the same company from year to year and see how it's been doing in its different accounts. So, to break this down, going to the common size statements. With the information provided to us from the given balance sheet right here, as far as how much cash or how much money is in each different account, from assets, liabilities, stockholders' equity, and whatnot. We split that up into 2017 and 2016, so same information for every account right here. And when calculating the percentages, you take from the total assets, which all equals 100%, you divide the amount of money by the total asset, for at least the total asset for all the assets involved in 2017 and 2016. You take the total asset, you take the specific amount of money within each account, and then you divide it by the total asset. And that'll give you the percentage for that account compared to the total. Same goes for the liabilities and owner's equity. When trying to calculate the various accounts, take the amount of money, divide by the total liabilities and owner's equity. And this will provide the percentages that you need for both 2017 and 2016. And from there, with the percentages all listed, you're able to compare how the company did as far as increases and decreases in various accounts from year to year. So once again, that is the benefit of using a common size statement. It's convenient to compare the way a company has performed. Moving on to the second problem. Second problem asks us to figure out what observations you can make based on the changes in the relative compositions of Y's accounts from the common size balance sheets. And it wants us to make at least 5 observations. So, based on the common size statement that we created, we have current assets have decreased, current liabilities are the same as total equities. So, going back to the statement, current assets have decreased. You have a 2016% of 14%, and that decreases down to 11.3% for 2017. Current liabilities also, there's an increase there. So from 2016 you have 10%, but in 2017 you have 10.8, so that's a 0.8% increase. Cash is also a smaller share of total assets, and inventory is a smaller share, while the accounts receivable has gone up. So right there, cash from 2.5% in 2016 down to 1.7% in 2017. Accounts receivable is 3.8%. Now it's 4.3%. And inventory, as well as accounts receivable. Just inventory. So yeah, inventory 6.2% in 2016 to 3.3% in 2017. Additionally, there was a major investment in plants and equipment, increasing a total of 11.8% from 2016 to 2017. Plant and equipment, 74.8 to 86.6. And bonds payable decreased by 8.7%, while short-term borrowing increased by 7.5%. All that is able to be seen, and we were able to compare that so easily because it was a common size statement comparing the 2 years from 2016 and 2017. For the third portion of this problem, it asks us to utilize the format provided in example 13.1 and prepare a comparative balance sheet for the Y company, including columns for dollars and the percentage increase or decrease in each item on the statement. So once again, you're pulling from that information that was provided to us in the original problem as far as the amount of money within each account from 2016 and 2017, and then you're breaking that up to calculate the dollar change as well as the percent change. It's the same data. As far as dollar change is concerned, you're taking the amount from 2017, subtracting it from 2016. You get increases and decreases in dollar change, positive or negative. And then for the percent change, you're taking the amount of dollar change, dividing it by the amount of dollars in 2016 to calculate the percent change from 2017 and 2016. Once again, positive and negative values. Pretty straightforward as far as the calculations are concerned. And then finally, the fourth portion of this problem asks us to identify the 5 items on the balance sheet that experience the largest change from one year to the next. And also to explain where we would find additional information about such change. So, 5 items is accumulated depreciation, prepaid rent, inventory, income tax payable, as well as short-term notes payable. So, accumulated depreciation, percent change 116%, prepaid rent, 50% change, inventory, 40% change, income tax payable, 40% change, and finally the short-term notes payable, another 40% change. These positive and negative. As far as where to look for additional information, we can look at the fixed asset records. Because accumulated depreciation can be compounded either on a monthly, annual, biannual phase, so you can just look at the fixed asset records. Prepaid rent, rental agreements between the rentor and the rentee. Inventory, so purchase orders and sales records for how much you've been purchasing or selling. Income tax payable on your tax returns. And short-term notes payable, which is the loan agreements. Sir, that completes my brief. If there's any questions, please let me know in the comments. Thank you.